Um, what are the 5 to 6 points to look for when you're trying to identify a multi-bagger?
It's a great question, and I could devote a PhD hypothesis to it. But here are the first few things I look. Here's the trick to finding multi-baggers, is to first find the value of a company. And how do you find the value of a company? Number of shares outstanding times the price. All right, that gives you the market cap of the company, and that's a starting point. So, for example, when Infosys went public, this might be hard to believe today. It's a 3 lakh crore market cap company. The market cap of the company was 50 crores. The 3 crore equity, 100 rupee price, so it's basically 30 to 40 crores the market cap of Infosys. Today it pays out dividends worth 4,000 crores probably a year or more, and today it's worth 3 lakh crores. So it's been one outstanding company. I'll give you another example that worked out and tell you how you capture the sense of value. After Infosys, I started looking at the other technology companies out there, and the government had divested some public sector companies. And there's a company that does the Indian railway systems. Anytime you travel, they make the tickets for you. Anytime you trade on the BSE, the software is done by that company. And that company was called CMC. And the government, it was available for 20 rupees at a 15 crore equity, 30 crore market cap. Now here's how your education and other background helps you. I was a techie, right? So I knew the value of that business. I mean, suppose I'd given IBM the contract to make the Indian ticketing railway system. They would charge the government $200 million to do it. And here you're getting this entire company, including the assets, other software for 30 crore rupees, That's value when you see that. Now, if you did the outstanding shares time price, you got the market cap. And you said, I would be happy to buy this company for 500 crores because I'm a techie, I know this business. And here the government is selling me 20 crores. Why not buy this? Because the gap between the intrinsic value of the company and the market value was so enormous. So the first part you have to do is to find the difference between that. If it's in your circle of competence, it becomes far easier to do that. Then you obviously look at the growth prospects of the company. You say, a cheap stock may remain cheap. If you're going to invest in a typewriter business, no matter how cheap it is, it's going to remain cheap. So you have to find a trigger for growth, something that will unearth the growth. We could see, for example, in the media industry, digitization happening. That would trigger huge value. In cybersecurity, we see the huge trend for people trying to protect themselves. So you've got to find a trigger for growth. If you marry these two, you're probably okay. The final lesson in this is that you have to think big. And what I mean is that when a bull market comes, you won't get rich by making 5,000 bucks or 10,000 bucks. You'll get happy, maybe have a good night out with your friends. But the trick is when you find a great stock, when you find this great value and you have this great conviction stock, is to back up your truck and buy a truckload of that stock. Because when that does well, that's when you become seriously rich. So you want to become Warren Buffett, you want to become Rakesh Jhunjhunwala, you want to become whoever is so idealized by the media. You need to be able to back up the truck, bet high on your conviction.